Good afternoon and welcome to this ACT webinar on the structural reforms affecting the derivatives markets. I'm Martin O'Donovan, Deputy Policy and Technical Director here at the ACT. Before we get going on the main presentations, could I just run through the few technical points on the webinar setup. There's a menu bar across the bottom that allows you to open various windows, and you can move these around your screen and resize them or minimize them. The green button there with a question mark is for help if you have any technical difficulties, and there's a red button there that opens the Q&A window, which you can send in your questions that we'll cover at the end in the discussion. Please don't wait to the end to send in your questions, but just send them in as soon as they occur to you. As I say, we'll take them at the end. We will be taking questions anonymously. I should add that there's a recording of this webinar which will be available on the ACT website in 2 days' time, and there'll be a separate copy of all the slides there as well. In fact, later on in this presentation, if any of the slides are a bit small for your screen, you can open a PDF file, which is using the dark green button there, and just use your normal Zoom controls. So, for the agenda today, we're delighted to have two expert speakers to explain for us the key parts of the US Dodd-Frank Act, how EMIR and MiFID in Europe will be changing the markets and execution rules, and then a bit more detail on EMIR, which of course brings companies directly into the world of financial regulation. Some of what we're covering applies to financial counterparties and not to the non-financial side, but I guess it's still important that we all understand the pressures on the banks, since this will have an impact on their ability and willingness to offer product to their customers, and of course its pricing. Our first presenter will be Ashwin Chat from HSBC, and in fact this webinar is being sponsored by HSBC, as is the whole of this series we're running on navigating regulatory change. So many thanks for your support and sponsorship. Our second presenter will be Chris Bates from Clifford Chance, who's been enmeshed deep in financial regulation and the evolution of all these new rules right from their start many years back. As I say, we'll then finish with discussion and the questions that you send in. So, let's get started. Can I hand over to Ashwin Chat from HSBC?
Thank you. Following the financial crisis, G20 goals broadly comprised establishing measures to reduce the risk of financial excesses destabilizing the global economy and fixing the broken regulatory system. Consequently, the regulatory change agenda broadly comprises market structural reform focusing on OTC derivatives, capital reform measures to improve the banking system's ability to withstand financial shocks, tax transparency rules to eliminate tax evasion, as well as bank structural reform measures to support orderly wind down without destabilizing services to the core economy, and finally market conduct rules to address conduct issues noted across the market space. Today's presentation will cover market structural reform with specific focus towards European and US implementation, including a discussion on their broader impact. Before diving into the detail, it's probably worth understanding that implementation of market structural reform, whilst differing in methodology and timing, broadly follows the same direction. Through measures such as trade reporting, regulators look towards collating market information. This information, combined with other sources of market liquidity, subsequently helps support determination of trade clearing eligibility. For trades subject to mandatory clearing, execution rules may also apply to support greater transparency. For trades considered ineligible for clearing, risk mitigating provisions such as timely confirmations, portfolio compressions, and portfolio reconciliations will apply. A majority of participants on this call have probably therefore been asked to provide representations confirming their classifications, possibly multiple times when they have European and American business relationships. So let's briefly cover key requirements from the Dodd-Frank and CFTC regime. These broadly look to cover registration requirements. As a swap dealer, should certain obligations be met, internal and external business conduct rules, including confirmation timeliness, as well as client communication guidelines, trade reporting obligations, including establishment of standardized data attributes such as the LEI, USI, and UPI. Mandatory clearing requirements for certain classes of liquidity swaps, which came into effect last year, as well as mandatory execution of trades on swap execution facilities for certain categories of OTC derivatives. This is one of the changes we'll discuss in more detail further into the presentation. Similarly, uncleared swaps will be subject to margin requirements, rules for which will be finalized towards the end of December 15, as well as requirements to hold appropriate levels of collateral to manage uncollateralized risk are expected to come into phased effect starting December 15. This slide briefly covers key requirements of the European regulatory changes being implemented through the EMIR directive. Once again, these broadly comprise requirements to report all new and outstanding derivatives, including OTC and exchange-traded derivatives, clearing requirements for OTC derivatives that ESMA will determine subject to mandatory clearing obligations at a later point this year. And similar to CFTC rules, there are risk mitigating provisions for uncleared derivatives covering timely confirmations, portfolio reconciliations, including dispute resolution, portfolio compressions, as well as margin and capital requirements for uncollateralized risk. Application of these provisions will vary based on underlying EMIR classifications, whether they would be FCs, NFC pluses, or NFC minuses. I'm pretty certain, again, a number of European corporates on this call will therefore have had the experience of being asked to confirm their classification, as well as provide additional representations to their banking counterparties over the past year. Chris will look to cover some of these aspects in more detail in the following presentation. So very quickly, let's do a brief comparison of market structural reform measures across EMIR as well as Dodd-Frank. Both have essentially the same starting point, i.e. G20 commitments, and introduce clearing margin rules based on IOSCO standards, as well as a series of risk mitigating practices. Finally, we also have trade reporting requirements, albeit with some variations. So CFTC requiring single-sided reporting, as against EMIR, which requires dual-sided reporting. Looking at implementation, whilst Dodd-Frank external business conduct rules cover sales practices, we have similar rules being covered through MiFID in Europe. Similarly, Dodd-Frank introduced mandatory execution of CEFs, whereas execution requirements in Europe will be introduced through MiFID. Finally, Dodd-Frank introduces real-time reporting on top of end-of-day reporting and mandates public dissemination of trade reports, whereas public reporting in Europe will again be introduced through MiFID and MiFIR. There are, however, key differences. Firstly, Dodd-Frank has a broader extraterritorial impact as a result of its definition of a U.S. person. Secondly, Dodd-Frank largely focuses on registered swap dealers, whereas EMIR applies to all derivative users with some end-user exemptions for non-financial institutions. Clearly, some members of this call would have seen changes as a result of this with conduit and guaranteed affiliates in some instances, which we'll probably look at as we go through a few slides further. So key takeaways include: 1, extraterritoriality remains an increasing trend and does add complexity and uncertainty over rule implementation. Both regulations often require institutions to engage clients multiple times in certain instances for remediation or operational purposes, as either new rules are introduced or existing rules modified. Meeting some of these requirements, an example being trade reporting, can therefore at times prove challenging for corporates that do not always benefit from the infrastructure and experience of banks. As a result, a number of banks have offered delegated reporting services to their corporate customers to assist with meeting EMIR trade reporting obligations. Let's now look at some of the specific changes, in particular execution rules and the broad industrial impact in more detail. So following introduction of mandatory clearing last year, mandatory execution rules on CEFs came into effect earlier this year. Essentially, a swap that's subject to mandatory clearing requirements and approved is made available to trade by the CFTC must be executed exclusively on a swap execution facility. As a result, bilateral execution would no longer be possible unless certain exemptions apply. A large majority of corporates today benefit from end-user exemptions from executing on CEF, However, they are impacted as financial institutions adapt their models to meet these new requirements, which we will briefly discuss. A clear impact of mandatory execution on CEFs for certain categories of swaps has clearly fragmented liquidity across U.S. person pools as well as non-U.S. person pools, and there is a sense of nervousness in the market of potentially offering different prices for the same product as a result from such fragmentation. We've also observed certain overseas affiliates of U.S. banks revoke parental guarantees of entities in Europe to continue operating on non-CEF platforms. This has allowed such entities to access non-dollar liquidity pools, which largely remained out of CEFs, and some of you on this call have probably had experiences of this through interacting with some of these banking counterparties. We've also seen instances of clients in Europe and Asia moving banking relationships or actually expressing a firm preference to face non-U.S. entities or non-European entities in certain instances as a result of some of these obligations. So collectively, there is a risk that regional liquidity pools may well be established as different regional regulators look to roll out similar requirements, which will make the market not just more inefficient, but potentially more volatile as a result of such fragmentation, which we've represented in the slide which you're looking at. There remain a number of operational challenges as well. With the relative quick pace of requirements, platform providers are often pushed to respond very quickly to these new requirements, which often results in inconsistent infrastructure development across CEFs, which could add more operational as well as legal risks. There also remain a number of open questions in the industry in response to some of these rules, including swap spreads, which come into effect mid this month. Whilst, however, there is an end-user exemption to trade off CEF for corporates, these rules can, however, have a direct impact. For example, an ability for a bank to pre-arrange a swap syndication at an efficient price supporting a corporate debt issuance could be adversely impacted, increasing hedging costs for such issuances. Let's look at that in a bit more detail. So as an example, a corporation could mandate a group of banks to issue a $1 billion 10-year bond on a fixed-rate basis in the U.S. capital markets on a given day. The issuer would also like to transform financing from a fixed to a floating rate and would therefore need to enter into an interest rate swap transaction at the time of financing. The issuer's goal would be for the swap to be executed as close to the bond price being established in the market to form an effective hedge. Since the underlying swap transaction exposes the issuer to substantial credit risk to the bank executing the derivative, they may prefer the ultimate physical swap be well distributed across their desired relationship banks. As a result, the swap can be syndicated across the desired set of banks within an agreed spread lock leading up to final price determination. Should these swaps meet made available to trade criteria, such inter-dealer trades will require execution on CEF, which will reduce the certainty of such syndication. This will result in higher execution costs in a raise since the bank arranging the swap will now have to price in that additional uncertainty of hedging their exposures, which in turn will increase the cost of such issuances. This, therefore, is an example of a direct impact to a corporate issuer, notwithstanding the end-user exemptions. Let's also briefly cover clearing and margin requirements. So the CFTC introduced mandatory clearing for certain categories of liquid swaps across credit and rates last year. EMIR will look to introduce similar mandatory clearing requirements towards the end of this year. As a result of timing differences in regulatory implementation as well as client preferences, we did see certain U.S. swap dealers commencing using overseas affiliates to book non-dollar business in regions that did not enforce mandatory clearing. It's also important to note that existing requirements do not currently include FX products, although we do expect NDFs to be mandated under CFTC rules shortly. Margin requirements for uncleared derivatives are expected to be defined towards the end of 2015 and will be implemented through a phased approach. The resultant impact will result in higher liquidity costs for institutions as well as increase the level of concentration risk to clearing houses. So having briefly gone through some of the market structural reform measures, let's try and briefly walk through their collective impact. From a pricing perspective, regional differences make it more difficult for financial institutions to continue to consolidate and manage risks more efficiently. This can result in increased costs for managing these risks, which in turn impact the pricing offered to our clients. The combined effect of new execution rules, collateral, and margin requirements are also likely to see a rise in liquidity costs. Pricing may have to take market reaction to large trades into account as well, as a result of increasing reporting transparency being implemented through both U.S. and European regulation. There has also been fragmentation and resultant reduction in market liquidity arising from some changes in execution rules that we just went through. This could result in deferring prices offered for the same product across liquidity pools, which could result in the market becoming more volatile should regional implementations of execution rules result in further fragmentation. The collective impact is therefore likely to result in higher costs for providing hedging solutions to corporates. For corporates, especially those with international banking arrangements, understanding the extraterritorial impacts in the absence of equivalence continues to be very challenging, particularly as they hold multiple banking relationships across the globe. This could get even more complex in the near term as European and Asian regulations begin to take shape, and in certain instances may require treasurers to reevaluate their financing and banking relationships, particularly where these are dependent on cross-border challenges. Similarly, non-sophisticated clients will therefore increasingly need more legal advice in navigating through the new world of platform-traded derivatives. As discussed before, this is going to be particularly true for large multinational corporates with international banking relationships. In the long term, regional divergences should hopefully converge to prevent unintended arbitrage and market disruption. However, till this happens, regulatory reform and related change will continue to remain a dominating factor, requiring sustained management and industry focus. In our final slide, we've provided a link to our HSBC Financial Regulatory Reform website, which a number of our clients have found very useful, which is not just restricted to market reform, but covers the broader pillars of regulatory change that we briefly discussed. On this note, I hand over to Chris.
Good afternoon. What Ashwin, I think, has shown is how much the system as a whole is changing. Clearly, banks are having to address a huge range of different requirements, new requirements that are applying to them as a result of these structural reforms, higher capital, new clearing requirements, margining requirements for uncleared trades, risk mitigation rules, reporting, and so on. But the issue for corporates is how they interact with this new system that's being created through these structural reforms. And what I want to do is talk a bit about the European aspects of these reforms in the shape of EMIR, the market infrastructure regulation, and how that will affect corporates in the coming years. It might be helpful to start by looking at where we are in the European regulatory reform process. And the slide on the screen now shows a timeline of the progress so far. And if you look at that, you can see that we have already implemented a large chunk of the reforms. We already have in place the operational risk mitigation requirements. The new capital rules have begun to bite on banks, and reporting has started to work, or not work, as some would say, given the difficulties of implementation. But it started to be required from February. What you can also see, though, is that some of the bigger changes, the money changes, the changes that will affect how much collateral, how much margin will banks and corporates will have to put up to trade in OTC derivatives have yet to come into place. The mandatory clearing rule could apply from the end of this year, probably a bit later, but that could be when it begins to start to apply to banks. Clearing of uncleared, as a margining of uncleared trades is likely to start in December next year. And some of the rules in Europe that mirror the Dodd-Frank rules that Ashwin mentioned, the platform execution rules, don't really begin to bite in Europe until 2017. And during that process, some other things are going on as well. We already know that quite significant amount of clarification is still required in order to operate the system. So we've seen, for example, debates around the application of these rules to spot FX and whether and the definition of when a transaction in foreign exchange is and is not within the scope of the rules, and that's happening as well. So there's a lot going on now, and we will see an increasing amount of activity in the near future as these rules begin to turn from what I would think of the operational rules to more to rules which have a direct financial impact. From the point of view of corporates, the big entry issue is are their companies over the EMIR clearing threshold? Because as we'll see in a second, this question, this apparently simple question, dictates much of the way in which the rules will affect the application of these requirements to non-financial corporates. And for most non-financial corporates, the answer that they want to reach, and I think that many of them have reached, is the answer is no, they're not over the clearing threshold. They are able to say that they are not NFC pluses, as we call them in the jargon. And that's a very important decision, and one which they have to be able to not only answer once, be able to answer continuously, not only for their EU companies, but for other group companies that might interact with EU banks. And the flowchart on the slide is quite simple, really. I mean, in summary, it effectively says how many non-hedging OTC derivatives do our group companies have, either internally or externally with third parties. And if you total those at non-hedging transactions up, are they over this clearing threshold? And most people approach the subject, most corporates approach the subject to say, we really only hedge. That's what we do, and that's why we can stay under the threshold. If you don't, then it becomes a much more difficult exercise to manage. But the consequences of reaching the decision that you're over the threshold are really very significant. And the next slide that you see on the screen tries to summarize that. As you can see, if you're over the clearing threshold, you have a whole range of obligations for your EU group companies, including mandatory clearing, margining, their pricing of their exposures. The bank's exposures to them will be affected by new and higher capital charges for CVA on uncleared trades. And there are a number of operational requirements as well as reporting to regulators. And even for non-EU group companies, there are very significant changes when facing EU banks, which mirror some of those requirements. So reaching the conclusion that you're under the clearing threshold, your group is under the clearing threshold, is very important. And the rest of this, my discussion really turns on the basis that we're assuming that you're not. And looking at it from that perspective, you can see that the EU requirements for corporates under the clearing threshold are in practice largely restricted to operational requirements. So they require status representations, requirements as to confirmations and interacting with banks on portfolio reconciliation, dispute resolution, and reporting to trade repositories. And similar issues for non-EU group companies when facing EU banks. I'd say there's one big caveat to this issue for the non-EU group companies at the moment. The European authorities are consulting on the application of margin requirements for under the new regime for uncleared OTC derivatives, and the proposal, as stated, would require banks to collect EU banks to collect margin for uncleared transactions from non-EU group companies, from your non-EU group companies, even if they're under the clearing threshold. The one practical area, or big practical area, that flows from all this is how much can you delegate the responsibility for dealing with these operational issues to the bank. And clearly on issues such as portfolio reconciliation and dispute resolution, corporates largely have done so. The main issue has been around delegated reporting. And a number of banks now do offer this service, effectively taking the reporting burden off corporates, either through what I've described as intermediary structure, where the bank stands effectively completely between the client and the trade repository, or in most cases, many banks offering a service which is more of a triparty operation, where the client, the corporate, holds an account at the trade repository, but the bank effectively channels the data to the trade repository on behalf of the client. So how does this overall affect your choice of counterparty? And looking at it from the point of view of EU corporates, I think it's clear that there is an element of bias. The system does bias EU corporates towards selecting EU bank counterparts. And by this I mean banks that are in the EU. They might be owned by non-EU entities, but banks within the EU, mainly because at the moment those banks should be able to offer or should be subject to lower capital requirements because of the idiosyncratic EU exemption from CVA for uncleared trades. But on top of that, banks within the EU will obviously be able to offer the delegated reporting and portfolio reconciliation and dispute resolution solutions that enable the corporate to offload essentially some of the burden of operational burden onto the bank provider. However, many non-EU banks now say, well, they will provide this service effectively as well, even though they're not directly subject to the EU regime. I think the main issue, of course, would bias EU corporates towards trading with EU bank counterparties is what I think of generally as regime aversion. In other words, the point that corporates would rather not engage with another regime which has different rules or requires them to make representations which they will have to understand and interpret in order to ascertain that they're happy with them. For non-EU group companies, of course, the position may be more balanced. Again, they may be able to access EU banks to take the service of transacting with the non-EU group companies for the lower risk capital requirements, but some of the other issues around delegated reporting and portfolio reconciliation will not apply. What I think the main impact on corporates that one's seeing is the generalized increased cost of OTC derivatives that is coming from the effects of these rules on the bank side of the equation. They aren't these rules that are not directly affecting the corporate, but are indirectly affecting them as their supplier of services becomes subject to a wider range of rules. And I think just to conclude, there are just a few other things that I'd mention in this regard. I think many people have looked at these rules, particularly as they apply to their non-EU companies, and think, well, are the equivalence assessments that the Commission is supposed to be doing going to make a big difference here? I think the answer to that is probably not. To the extent that the non-EU company is subject to the EU rules, it's relatively unlikely the equivalence assessments will make a big difference. Will people move towards voluntary clearing, voluntary trading on the new platforms? I suspect that most corporates would rather stay with what they see as the tried and trusted routes of bilateral trading and bilateral clearing, essentially, of their transactions. Scope issues remain a big deal. I think the whole question of differences in scope between the regimes, the different treatments of FX transactions are something that do concern corporates. When are they actually within the scope of these new rules to have to even begin to worry about it? And of course, the other issue for many corporates is that it's fine to focus on delegated reporting for their transactions with banks, but they still have to trade. They still have to move the risk around within their group, and those transactions themselves are subject to reporting and risk mitigation techniques if they involve an EU company, and there aren't banks or third parties at the moment providing those services to resolve that. I think that the The final point is that, as was made, was that these regimes continue to develop, and I mentioned the possible application of the rules on margin to non-EU corporates. We have to wait and see. But when people are moving out from the EU and the US to think about their application to their group companies in Singapore, in Africa, in Latin America and the like, we can see those regimes already those countries already beginning to develop regimes which may not be quite as extensive as the EU and the US, but still involve compliance and administration issues for corporates, which they begin to address. And so I think, picking up on Martin's original point, that the financial regulation coming to the corporate, I think we're going to see that not just here in the US and Europe, but of course around the world as well. And with that, I'll hand over to Martin.
Right. Thank you very much, Ashwin and Chris. Time now to move on to our panel discussion of the questions you've been sending in. I've just got a couple here which are fairly matter of fact, I think. FX clearing threshold. Is it the net value outstanding or the gross total? I think that's... is that for you, Chris?
Yeah, the clearing threshold is based on gross amounts.
So even if you've got some deals which in risk terms net themselves off,
yes.
It doesn't look to that. It takes the
no, I mean, if those are hedging transactions, of course, then they're out of scope, yeah. So
we're talking about only non-hedging count towards that threshold.
Yes.
There's another sort of fairly matter-of-fact one, I think, here. I think it might be for you, Chris. Are UK branches of foreign banks, non-European banks, do they also have to comply with EMIR reporting? So it's a UK branch of a non-European bank.
The position of at least some regulators is the answer is no, that the EU regulations do not apply to the European branches of US or Asian or other banks. There are, however, I'm aware of some European regulators who take a different approach. So I think we can't be entirely categoric about this. I think from the corporate's point of view, it sort of doesn't matter in a way. Your own if your solution to EMIR reporting for your European company that's facing that entity is delegated reporting, then they will either have to be able to offer that service to you, or you'll probably end up saying, well, I can't trade with you because that creates a difficulty for me. So, and the point I was making was that in many cases, non-EU banks that are not subject to the reporting rules, directly subject to the reporting rules themselves, are willing to do delegated reporting for to help their EU counterparties effectively overcome their own compliance requirements. I'm aware of several banks that are willing to do that.
Thanks for that. I think one of the points coming out here is the whole world of clearing, margining, collateral. So I've got a question here. If a company has access to large cash balances, would it be cost effective to use these as collateral on derivatives? I think Chris was saying that in terms of pricing, a collateralized deal won't be subject to the same CVA capital charge. So in theory, a collateralized deal should be more cost effective. Ashwin, is that something you can comment on?
I think when we've looked at our internal analysis in terms of liquidity cost versus related capital benefit, we've noticed some benefit, but not particularly as substantial as one would hope. So effectively, it again begs the question in terms of comparing the cost of liquidity versus the capital costs. And so far, we've not seen anything substantial coming out of that. So clearly, there will be a benefit. I'm not entirely certain it will be to the level one would hope it would.
So, I mean, Joe, this is a follow-on from myself, really. Is over time, do you think collateral will become a more normal practice for non-financials, particularly because it does insulate them from the risk on the bank as well, if it's collateral in both directions?
I think if it's not mandatory, it's unlikely at least in the short to medium term from what I've looked at. So I probably think unlikely.
Certainly, most companies seem to be fairly loath to embark on that just at the moment. I've got another one here on the clearing threshold. Chris made the point about being under the clearing threshold. What's the experience so far on how corporates that are below the clearing threshold are documenting and evidencing this? How detailed is this done, and how often is it refreshed? So what do you have to do to prove you're under?
Well, I mean, Ashton has probably got views as well, but I think this is a difficult issue because, obviously you only have a few derivatives transactions. This is relatively straightforward, but of course for many companies there's not just a few transactions that might be in scope. I think that anybody thinking about complying with this, firstly, has to have some sort of policy and procedure structure to be able to administer this. And the first point is you have to know where the derivatives being done in your group. That's the first question, and ensure that new entities don't start doing derivatives unless they know and are aware of the requirements. So the first thing that I think anybody serious about ensuring that they comply with this requirement is some sort of policy framework which controls which entities do transactions and how and make sure that they're aware of the requirements. I think then there needs to be some sort of policy framework about the use for which derivatives are put and the circumstances in which the use to which derivatives are put and the circumstances in which they can be entered into. And I think that the key issue here is that the guidance such there is some guidance in the questions and answers from ESMA on this, which is worth looking at if you're looking at this framework, is that I think generalized assertions that we only hedge really won't cut the mustard, that you need something more specific. And I think the difficult point is, and probably can only be answered on an individual case basis, is the sort of, whether one has more detailed policies to sort of trade by trade, being able to demonstrate that this particular trade was tied to this particular risk. And I think that's the issue that people are wrestling with if they have a significant volume, is the extent to which you have to granularize the evidence base so that you could say, if asked, well, we not only had some generalized policies, but we implemented them because we can demonstrate that trade by trade, each trade met the hedging requirement.
Okay, good. Turning now to the big picture here, the regional liquidity pools and regime aversion, is an unintended result going to be a reduction in globalization? So,
yes.
Ashwin?
Well, the short answer is yes. There's clearly an unintended impact. I think sort of what briefly, the broad impact is, what this could result in is, as we mentioned, fragmentation of liquidity and almost balkanization of some of these rules, resulting in regional pools. What that then has is it immediately impacts financing costs and the ability for both institutions as well as end users to hedge their commercial risks efficiently. There's also the unintended impact of potentially increasing market volatility, because if you start thinking about it, one of the benefits of having a larger liquidity pool is one that improves resilience of the underlying market. So the moment we start fragmenting this, we essentially unintentionally end up reducing the depth of the market and therefore its resilience. And clearly there could, as a result, be unanticipated shocks, market shocks to fairly benign pieces of political announcements, as an example. However, it's not that doomsday scenario. Clearly the regulators, the institutions will make a concerted effort to remind the regulators of what some of the unintended impacts are going to be, and that remains a fairly proactive joined-up approach. And we're hoping as implementation of these rules comes forward, there will be greater convergence and recognition to address some of the unintended impacts.
Yeah, because presumably, if people are nervous at the moment about equivalence and just how do the different rules relate, but presumably with time that will become clearer.
I think so, because I think it comes back to this issue of, yes, there is a regime aversion, if you like, if I can use that term again, but people will be incentivized to overcome it, and the question is how much investment do they need to make to overcome that, and are there benefits in doing it? If there are no benefits, then people are not going to do it. But to the extent that if one, say, European corporate, and you say, well, I don't like doing Dodd-Frank representations because it's difficult to do, once you have done it, then you're fine with it, and you've overcome that aversion, and then you've opened up potentially a wider group of counterparties that you can deal with, and so it's that sort of barrier. As long as it is just a sort of barrier in terms of a learning cost, then once that cost has been spent, then the barrier disappears. I think the more fundamental issues are the issues that Ashwin was talking about, which relate to actual barriers such as execution barriers, which are not just a question of a learning cost. Those are actual different treatments which exist on which people may not be willing to can't overcome in the same way.
Okay, thanks for that. I think probably our last question here, moving to the sort of world of execution. There's talk about different platforms and SEFs and so on. Perhaps you could clarify, will corporates still be able to deal derivatives bilaterally over the phone? Ashwin?
I think in the short term, my answer is going to be yes. So it will be the tried and tested method. However, sort of MiFID is introducing new rules over trading venues, as well as placing additional obligations on institutions that fall within the systemic internalizer regime, which are still under review. So in the short term, my answer is yes. In the medium to long term, I think we just have to wait and see as we go through some of these rules in more detail.
Some of those effects might be indirect, because if you're an NFC minus, if I understand it right, you're not mandated onto those sort of platforms.
Yes.
Yeah. Okay, so it's more the indirect effects of your bank having to deal through those platforms or exchanges. I think, and I fear that the time has come to wrap up, so if I could now give my thanks to our presenters and to HSBC for their sponsorship, and thank you too for everyone who joined in this session and sent in questions. I'm sorry we didn't quite get round to dealing with all of those. As I mentioned at the start, we'll be putting a recording of this webinar up on the ACT website, and along with the presentations, and that will be up in about 2 days' time. We'll be sending you all a link to that. Looking forward to the rest of the year, we have another webinar next week on pricing credit risk, and that's followed shortly by a breakfast briefing on supply chain finance. And then a bit later, towards the end of June, we have the ACT Europe conference and further conferences throughout the rest of the year. So do keep a lookout for those. So can I thank you all for listening? If you could spare us a moment to provide some feedback on the webinar, that would be great. If you select the little red widget at the bottom, allow you to fill in a few questions for us. And that facility will stay open for a few minutes or so after the end of the webinar. So from all of us here, thank you and goodbye.